If you're thinking about selling a home anywhere in the United States, congratulations. But before you start dreaming about that down payment on a new home or what you're going to do with all that cash, there's one thing that you really need to consider: taxes. And the taxes that you can pay on the money that you make from selling your home is called capital gains tax. Now, this is a tax that can take a big chunk of money out of your profit before you put it in your pocket. So when you sell your home here in the United States for more than what you initially paid, you'll be subject to capital gain tax on that profit. However, there are a few ways that you can avoid paying these taxes, and this is why I'm making this video. It's for you. Now, I've seen some people who have made some absolutely huge mistakes, and I'm not an accountant, I'm not an attorney, but as a real estate broker for the last 20 years, I have seen it all. And my goal is to help as many buyers and sellers avoid those pitfalls that are costly. So give me a thumbs up if you're good with that. Now, here are 4 super helpful tips that you're going to want to know about. Number 1 is the 121 exclusion. So if you've lived in a house for a while and you're going to sell it, you may be able to keep a big chunk of that money tax-free. Now think of it like this. Imagine that you bought a house for $1 million. I know not everybody has that, but just imagine this. Now you're selling that house for $1.6 million, which is $600,000 more than you initially paid for it. So that's $600,000 is your profit. And normally you'd have to pay taxes on that. But if the house that you're selling is your primary residence and you've lived in it for at least 2 years out of the last 5 years, your whole profit could be tax-free. And it doesn't have to be 2 consecutive years. You could have lived in that house for at least 2 years in the past 5 years, and you can still qualify for this 121 exclusion. So let's say you lived in that house for just 1 year, and then you moved out of the house on year 2. And then you lived in that house again for a year. That's 2 years total in the last 5 years. So just realize there is a limit on how much profit you can exclude. So if you're a single person, you can exclude up to $250,000 if you're selling a house, and up to $500,000 if you're a married couple living jointly. So let's take this previous example again, because I want to show you this. You bought this house for $1 million and you're about to sell it for $1.6 million. So that, again, that's $600,000 as profit, which could be taxable. But if you're selling the house as a single homeowner who hasn't married yet, you can write off $250,000 of it, and you might only have to pay taxes on the rest of the $350,000 for profit. Now on the other end, if you're a married couple, you can write off $500,000. And now the rest of the $100,000 is taxable. So we can talk in a moment, and I want to show you how to avoid capital gains on the rest of the $100,000 as well, because this is where you can really get a little bit tricky. And some home improvements you may have made, you might be able to get those written off. So if you profit from selling a house on more than the exclusion limit, you may have to pay taxes on that extra amount. But if you actually add the money that you've spent on improving your home to the original purchase price, that's called an adjusted basis. Now, this actually means that you can put taxable $100,000 worth of home improvements. It could be potentially reduce or eliminate your tax bill altogether. And this is important to keep detailed records of all your home improvement expenses that you make. This is the reason why, because these records could be super helpful, and you will need these to prove your adjusted basis to the IRS. Now remember guys, you can only use the 121 exclusion once every 2 years. Plus, the exclusion only applies to your primary residence, the house that you actually live in. It doesn't work for vacation homes or investment properties. So if you're an investor, this $250,000 or $500,000 exemption rule doesn't apply to you. But number 2 may help you, and this one's a beauty. It's the 1031 exchange. And there's another way to avoid capital gains taxes for investors and their investment properties. And this is similar to the previous 121 exclusion that we just discussed. And I know a lot of people get confused at this, but just hear me through. So when you sell your investment property, instead of paying taxes on that profit, you can actually use that money to buy another investment property. This is called a 1031 exchange. So you're basically just swapping one property for another under this law if you meet the timeline. Now this is how it works. It's only going to work for investment properties and not your primary residence. And you're not going to avoid taxes completely, you're just going to delay them. You're going to push it way down the road. Now either you or your heirs are eventually going to have to pay some taxes somewhere. So when you finally sell that new property, this is where you could actually go and do another 1031 and push it even further with that exchange. But just remember, this is useful for real estate investors who want to keep growing their portfolio without paying taxes right away. And this is how a lot of common people have gotten ahead. Now, a 1031 exchange is a complex process and it has specific rules and regulations, so it's always a good idea to consult with a tax professional that understands the law and how this might affect your personal situation. Now here's number 3, combining the 121 exclusion and the 1031 exchange. What? You can do that? Look, there are certain scenarios where you can combine the 1031 exchange and a 121 exclusion. Now look, I live in Myrtle Beach, South Carolina. It's a vacation rental market. There's beach houses and condos on the beach, oceanfront. But people also retire to our area. So here's how this works. A, imagine you bought a property as an investment. Now think about this as a beach house or an oceanfront condo, as I mentioned. Now you rented it out, but you decide to retire and move into it to make it your primary residence for at least 2 years. When you finally sell that property, you might qualify for the 121 exclusion because you live there, right? But if you profit more than that exclusion limit, you can use the 1031 to defer taxes by reinvesting that money into another investment property. Now here's what it looks like in dollars. Picture this. So let's say you sold your house for $500,000 that you initially bought for $200,000. Now that means that you made a profit of $300,000, right? And if you're single, you can write off $250,000 of profit from taxes, which means you still have another $50,000 of profit that could be taxed. But instead of paying taxes on that $50,000 profit right away, you can use it to buy another investment property. This lets you delay paying taxes until you sell that new property. Now, here's another scenario. It happens, right? Scenario B. Another scenario is where you transform your house into a dual use property, kind of like a duplex. Think of you live in one side and you rent the other side out. And a lot of people do this. But when you sell that property, you might qualify for the 121 exclusion for the part of the property that you lived on because you used it as your primary residence. However, the rental portion of that property is also considered an investment property. So you can use the 1031 exchange on the rental portion of that property. Now this means you can defer paying taxes on the profit from the rental unit by reinvesting the money into another investment property. And there's other scenarios where these two laws can be combined, but it would require a lot of planning. So I always highly recommend you talk with an experienced tax professional before you take this step. There's a fourth tip that I want you to know about. Number 4 is the low income tax bracket. Now, if you don't make a lot of money, there's a chance that you're going to be in a lower tax bracket. Now, this means you pay less tax on your income. So in some cases, you might not have to pay any tax on the money that you make from selling your house. And these are all federal laws. So a lot of times this also applies to states in the United States. So remember, individual states, they might have their own tax codes and income tax brackets. So check with your accountant, again, depending upon your state. But just remember, you might not owe federal capital gains tax on the sale of your home due to your low income, but you could still owe a state capital gains tax. And that's why I always, again, highly suggest that you talk to a tax professional before you make any decisions. But if you're buying or selling, this is what I always say. You don't need average. You don't need average, you need way above average. And you need an experienced real estate agent who's really aware of the ins and outs of the real estate market. And if you have the right real estate expert who's working for you in your best interest in all relevant areas of that transaction, that expert should be able to give you personalized tips and guide you through the selling process. And if you need help with that, I can hook you up with your local expert. No matter where you live in the United States, just pick up the phone, give us a call, 843-839-9870. I got a question for you. Was any of this helpful at all? Let me know. Put it in the comments. I really want to know. Or share this with somebody you know who could really use this information. I'm Jerry with Jerry Pinkas Real Estate Experts. My real estate team is here to help you find your hidden gem and avoid those pitfalls that are costly. So if you're thinking about buying a house or selling in Myrtle Beach, South Carolina, or anywhere in the United States, again, just pick up the phone, give us a call. We can help. My team has helped thousands and thousands of people successfully move in the past 20 years. And we've seen just about everything when it comes to selling a house fast and selling it for maximum value. So until next time, stay happy, stay educated, and I hope you're having a fantastic day. Take care, guys. And I'll talk to you soon.